General Motors has just dropped a bombshell on the U.S. auto industry, with an impulsive and highly aggressive move that's catching everyone, from rival automakers to dealerships, completely off guard. Without any advance notice, GM has slashed prices across a wide range of its vehicles, triggering a chain reaction that could destabilize the pricing structures of the entire industry. From its best-selling pickup trucks like the Silverado to its newer electric models like the Blazer EV and Bolt, GM is rolling out price cuts as steep as 15% to 20% in some regions, essentially rewriting its own playbook overnight. This isn't your typical end-of-quarter incentive or dealer cash offer. This is a structural shift, signaling that GM is willing to take a short-term profit hit in exchange for long-term market control. Behind the scenes, insiders suggest the move is a desperate response to mounting inventory problems. With rising interest rates, a cooling job market, and consumer credit tightening, dealerships have been sounding the alarm for months. Parking lots are filling up, floor plans are becoming expensive to manage, and consumer demand has not bounced back as anticipated. GM, it seems, decided it couldn't afford to wait any longer. Instead of slowing production or quietly adjusting incentives, the company hit the panic button and unleashed a full-blown pricing war. And now, the ripple effects are undeniable. Ford is under pressure to match GM's pricing just to keep F-150 sales competitive. Stellantis, already struggling with its Ram inventory backlog, could be forced into even deeper discounts or temporary shutdowns. Even foreign automakers like Honda, Hyundai, and Toyota are suddenly facing a U.S. market turned upside down, where value shoppers now expect dramatic markdowns, and loyalty to brand could be outweighed by price. Meanwhile, consumers are rushing to dealership lots, hoping to cash in on what feels like a fire sale. Social media is buzzing with posts about five-figure discounts, zero-interest financing, and once unthinkable lease offers on high-demand models. While this is great news for buyers in the short term, it's sending shockwaves through dealership networks. Many dealers, especially smaller ones in rural or suburban areas, are overwhelmed by the abrupt change. They're forced to sell new vehicles at razor-thin margins, or in some cases, at a loss, just to move inventory and stay afloat. The backlash is growing. Several dealer groups are reportedly demanding emergency meetings with GM executives, frustrated by the lack of communication and fearful of what this pricing strategy could mean for their future viability. After all, if prices keep falling and profit margins disappear, who's going to keep the lights on at the local level? Financial analysts are also raising red flags. Wall Street has already reacted to GM's announcement with skepticism. Shares dipped following the news, with investors worried this signals not strength but desperation. They fear GM is burning through pricing power just to protect volume, at the exact moment when competitors like Tesla are ramping up efficiency and other legacy automakers are slashing costs. One auto analyst called it the nuclear option, suggesting GM may be betting everything on winning a price war that could devastate the entire sector. And it's not just about today's sales. It's about what this move does to resale values, brand perception, and long-term financial stability. Lower new vehicle prices will inevitably drag down used car prices too, hurting trade-in values and making it harder for automakers to offer strong leasing programs in the future. Internally, GM is doubling down. Executives insist this is a calculated risk designed to dominate market share while others hesitate. According to leaked internal memos, the company is planning to roll out even more aggressive pricing strategies through the summer, with a particular focus on its EV lineup, where adoption has stalled amid high sticker prices and range anxiety. The idea, according to sources close to the leadership, is simple: flood the market, win over budget-conscious consumers, and force lagging competitors into a corner. It's a strategy rooted in old-school Detroit muscle, but in today's highly volatile and data-driven market, the gamble could either make GM the undisputed market leader or push it dangerously close to financial instability if sales volume fails to meet projections. The Biden administration is watching closely as well. With upcoming elections and a fragile economic recovery, the White House has a vested interest in keeping the auto sector stable. Sources suggest government officials have already begun informal conversations with major automakers to assess whether This pricing war could trigger broader economic consequences, especially in manufacturing-heavy swing states like Michigan and Ohio. Some economists warn that if other automakers retaliate by cutting prices too, it could lead to widespread job cuts, plant slowdowns, and another wave of supplier bankruptcies, particularly among smaller Tier 2 and Tier 3 vendors who operate on thin margins and depend on steady order flows. While GM's pricing blitz might win short-term praise from bargain hunters and volume chasers, the long-term risks are far more complex. Suppliers across the Midwest are already bracing for turbulence, with many fearing abrupt order revisions and payment delays as GM tightens its belts on component costs to offset its revenue drop. The automaker has reportedly begun renegotiating supplier contracts, pushing for lower part prices and faster turnaround times, which could create a domino effect down the supply chain. For the thousands of small machine shops, electronics fabricators, and logistics providers that make up the backbone of GM's production ecosystem, this sudden shift could spell layoffs, cash flow crises, or even closures if margins are squeezed too tight. At the dealership level, the mood is tense. Franchise owners who've weathered decades of market cycles say they've never seen a move this aggressive, this sudden, or this potentially destabilizing. They're now scrambling to adjust advertising, retrain sales staff, and renegotiate with banks to reflect the new valuations. Lenders are starting to tighten their criteria, wary of falling vehicle values and higher default risks. Some banks are even reconsidering residual value assumptions on leases, knowing that today's discount could become tomorrow's loss if market prices keep sliding. Meanwhile, floor plan financing, the credit lines dealers use to keep inventory on hand, are becoming a greater liability, especially if vehicles sit too long and depreciate before they sell. For customers, it's a rare moment of leverage. The average transaction price, which had soared to over $48,000 in recent months, is now starting to decline. Incentives are back on the table. Cash-back offers, discounted financing, and flexible lease terms are suddenly abundant, especially for EVs and full-size trucks. Even better, used car prices, once inflated by pandemic-era shortages, are finally correcting as a result of the new vehicle price drop. But there's a catch. Not every region or dealership is reacting the same way. In some urban centers, inventory is still tight due to supply chain gaps, meaning deals could vary wildly depending on geography. And while some buyers are thrilled by the lower prices, others are furious, especially recent customers who paid full price just weeks ago, watching their vehicle's value evaporate overnight. This reactionary pricing shock is also complicating the already fragile EV transition. GM has been investing billions into electrification, but with EV adoption lagging behind projections, cutting prices on electric models might be a double-edged sword. While it may increase volume temporarily, it also threatens to devalue the entire EV segment, sending a message that these vehicles can't sell without steep discounts. That perception could hurt GM's brand image, especially among early adopters and tech-savvy buyers who are sensitive to quality and resale value. Tesla, on the other hand, has already gone through several rounds of price drops and adapted quickly. But legacy automakers like GM are less agile. Their dealer networks, cost structures, and legacy commitments make sudden pricing pivots far more disruptive and expensive. Meanwhile, Ford and Stellantis are caught in a strategic bind. If they match GM's price cuts, they risk entering a zero-sum war that destroys profit across the board. But if they hold firm, they could lose critical market share in segments they've traditionally dominated, like full-size trucks and family SUVs. Industry insiders say secret meetings are already underway at Ford's headquarters in Dearborn and at Stellantis North American HQ, with executives reviewing pricing scenarios and potential countermeasures. One option being discussed is delaying the launch of new models until the pricing environment stabilizes, or offering limited production trims to create artificial scarcity and justify premium prices. But with GM flooding the market with discounted units, those strategies could fall flat.